Hello everyone, and thank you very much for joining us in the latest of the BetaShares webinar series. Today, specifically, we're going to be focusing on the opportunities in climate change innovation, specifically around our new fund launch, the BetaShares Climate Change Innovation ETF, ERTH. Before I start, the usual disclaimers to go beforehand. Please remember that everything we speak about is general in nature. It does not take into account your personal circumstances. Always read a PDF before making an investment or seek financial advice. Past performance is not indicative of future returns. And today we're joined by a third party as well. So some views you may hear are not necessarily the opinions of BetaShares ourselves. As many of you would know, as with all of our BetaShares webinars, we do send out a recording to all those who have registered, including attendees, so you can listen again at your leisure. We've had quite a few questions which have been submitted prior to the webinar. We'll look to address those hopefully as we go through, but there's time saved at the end for Q&A, and you'll see on the side of your screen, you can click a questions bar and submit any questions, and we'll look to answer those at the end of the session. We post a lot of regular content across the board here at BetaShares, predominantly on our website. You can also sign up for our regular insights on our newsletter from our Chief Economist, David Bassanese, and other members of the BetaShares team. You can also follow us across the general social media links, as you can see on the right-hand side. Very quick update on BetaShares. We're an Australian-owned and managed ETF provider. Here we manage over $17 billion of assets across 62 different strategies, really focusing on Australian investors being our core client base. So solutions for Australian investors in mind. My name is Alistair Mills. I'm a director here at BetaShares. I focus mainly on the institutional and broker research client segments. I'm extremely pleased to be joined by Nathan Lim today, who's head of research at Morgan Stanley Wealth Management. Good afternoon, Nathan.
Yeah, Alistair, thanks for having me back on the show.
You're very welcome. Now, Nathan's going to provide a real bit of insight for us here. He's got a plethora of experience across portfolio management, investment research, and really is an expert when it comes to responsible investing. So with that, Nathan, I'll hand over to you. If you could please provide a bit of colour on Morgan Stanley's investment process and how potentially you incorporate some ESG into those.
Sure, no problem. Thanks, Alistair. And thanks again, BetaShares, for having us on the show. And hi, everybody. Good to catch up with everybody. So I was invited today sort of to give a bit of a brief overview on our thoughts around where the opportunities are are we in a carbon constrained world. But before I get into that, I thought it'd be very insightful to sort of put my comments into context and understand where we're coming from and how this fits within how we think about risk in portfolios. And so, first of all, the first slide that you have here is our investment process. We basically have a four-pillar process that is built first on asset allocation, both strategic and tactical. Then we make a determination on whether or not we want to use an active or a passive strategy. We will select a manager to implement that strategy. And then ultimately, we actually manage the portfolio and we manage the risk in that portfolio. This entire investment process is supported by Morgan Stanley's global research network. We have over 750 analysts, strategists, and economists operating out of 21 countries around the world. We then overlay on top of this sort of fundamental framework, our conventional framework, our investing with impact framework. So if I can just advance this slide. And what you're looking at here is that we basically are trying to help our clients invest in a manner that is consistent with their values. And at Morgan Stanley, we basically see that there are effectively four different ways of doing that, all right? And so I'll just go through each one of them quickly. First of all, with restrictive screening, this is kind of where responsible investing really started from. This is most closely associated with ethical investing. It's very black and white. This largely reflects the personal values of an individual or an organization. If somebody doesn't want to invest in liquor or gambling, that's just, there's no revenue thresholds or anything. That's just simply a black and white determination in our mind. The second sort of way that we think about responsible investing approaches is around this ESG integration, or environmental, social, and governance integration. And this is really about incorporating non-financial factors into fundamental analysis. Now, I've used this example previously when I've spoken to our clients, is that a simple way on how we do this, or how I do this, is that I like to look at the back pages of an annual report and look up the lost time frequency data. And I like to see like how many people were hurt or at worst killed on the job site. I think this to me speaks more than anything else about the culture at an organization, because if they can't even bring their own staff home, what hope do you have engaging with such a business as a supplier, or as a customer, or even as an investor, all right? Now, however, it's increasingly become our view that responsible investors, those that are really serious about incorporating responsible investing principles into their approach, they kind of already assume that a lot of companies are doing the right thing. Now, this is probably more so, especially in developed markets, where there is kind of an expectation that companies are obeying the law, treating their employees fairly, and they're competing fairly. As such, we're kind of thinking that it is increasingly just an expectation that companies should have good ESG practices or high ESG scores. That's kind of just a given, right? So the way we're thinking about ESG, or environmental social governance, is that if that is the how, the United Nations 17 Sustainable Development Goals is the why, okay? Now, remembering that there are multiple stakeholders in any organization, a business, it must still ultimately be profitable to be sustainable, to ensure that all these stakeholders can be supported indefinitely, and thus the importance of considering ESG factors, right? Now, if the same organization then targets a societal goal, this gives purpose to the organization beyond the needs of a single stakeholder, which is ultimately what we believe responsible investors are looking for. So the SDGs in our mind are a common denominator between investor values and a taxonomy that we can discuss with the market to connect both sides, all right? Now, for example, when an investor is seeking to support gender equality or solutions to tackle climate change, these fall under SDGs 5, 7, and 13. This means that a fund manager who incorporates SDGs into their investment process is going to very likely align with the values of this responsible investor. Lastly, just on that slide, I think the other fourth most important, the other really important impact approach that we have is around impact investing. And this is where we see where we're trying to deliver a very specific societal or economic outcome. What we're talking about here are things like rural solar projects or social housing projects. This is largely the remit of private equity investors, all right? Now, so with this context and with this sort of background, let's bring it back to the title of today's webcast, The Road to Zero, Opportunities in Climate and Innovation. Now, from my perspective, whenever I see words like opportunities and innovation, I actually think about the risks and the downside first, because more often than not, when someone is winning, it's coming at the expense of someone else. So going back to our investment framework, this falls under risk management. One of the biggest risks I see right now is climate change, in the sense that any company where fossil fuel is a major input, the cost of that input is going to go up as the cost of carbon gets internalized. What we're talking about here is whether or not we actually will put a tax on carbon, or we're going to cap carbon, whatever the case is going to be, carbon as a cost is just going to be rising from here in the future. So in this way, I think it's a lot easier to pick the losers in a carbon constrained world than the winners. Now, for example, I think one area of risk is the entire thermal coal supply chain. They're going to be confronted with how to deal with all these carbon constraints. Now, alternatively, who's going to win? I think that's where it gets a lot more difficult. Now, for example, like Alistair, let me ask you a question. Have you ever had one of those meat-free burgers?
I have not yet, no.
All right, well, if you ever get a chance to try these meat-free burgers, they're incredibly tasty, right? Researchers have basically figured out and identified the enzyme that makes meat taste like meat. So when you combine this enzyme with vegetables, it's like eating a real beef burger. From a sustainability perspective, this is a fantastic breakthrough. When you think about all the cows that we no longer have to raise, or all the forest that we no longer have to cut down to make way for all these pastures. In fact, the United Nations estimates that livestock accounts for about 15% of all the human-related greenhouse gas emissions. Now, you would think this is surely a winning technology in a carbon-constrained world. A couple of weeks ago, Morgan Stanley, we just recently published a report on cultured meat. This is meat that is grown from a single muscle tissue. What you end up with is meat because you started with meat. Now, they've already started to produce chicken nuggets with this technology, and surprisingly, yes, it does taste like chicken. Now, going back to that plant-based material solution, how certain are you that plant-based meat is the future winner in a carbon-constrained world? Similarly, when we start talking about electric cars or battery technology, are you sure that lithium ion is the winning chemistry, given that we know that Toyota is reportedly about to launch their first electric vehicle, which is going to use solid-state batteries. Solid-state batteries are reportedly going further, charge faster, are safer. They're smaller than lithium-ion batteries. There's a real differentiation with this new type of battery technology. So bringing this all back to today's topics, there's definitely, in our mind, a big opportunity in addressing the needs in a carbon-constrained world. However, picking the winner, that's kind of the hard part. You kind of have to manage the risk while at the same time position yourself for potential winners. We think the best way for you to do that is to maximize your chance of success by using diversification. Spread your search for winners across industries, across technologies, because in this carbon-constrained world, we're going to need many solutions to be able to beat climate change. So look, that's the end of my prepared comments, and I'm going to pass it back over to Alistair.
Thank you very much, Nathan. That's actually really interesting. Some really good examples of some of the companies that you might gain exposure to, but different ways you can think about managing your risk across portfolios if you are looking to invest in exposures like this. And you alluded to it there, but ESG, or responsible investing, has become a core part of most people's investment philosophy and really is no longer a niche part of the market. If you take our environmental, social as an example, across Australian equities, international equities, fixed rate bonds, and diversified exposures, we manage over $2 billion. And in the Australian ESG ETF market, or ETP market, we have taken over 2/3 of all flows in the last 12 months there. It's really becoming a fundamental part of our business. And in the most recent launch, we were looking to provide more of that impact exposure. Whereas ETHI and FAIR, the sustainability leaders funds, look for those sustainability leaders, so companies which are potentially best placed to benefit from this, or are best placed as we transition across to a net zero carbon economy. ERTH provides exposure to the companies, technologies and solutions which are enabling governments and corporations to set and achieve these goals. So if you look at the fund breakdown itself, the BetaShares Climate Change Innovation ETF, or ERTH, provides exposure to 100 of the largest companies which are deriving the majority of their revenues from products and services which are driving change and enabling the reduction and avoidance of CO2 emissions across the board. It currently holds 96 securities. The management fee is 0.65% per annum. And it is a fully global exposure. There are currently no Australian investments within the portfolio at the moment. So looking as to why we launched a product like this, there was a monumental amount of demand across the board from investors really looking to allocate capital to an exposure which enabled them to drive change. But if you look at the investment rationale behind why you might invest here, first of all, you've got those huge regulatory tailwinds. So companies and governments across the world have agreed a net zero target by 2050. We've had 196 nations across the world actually agree that, well, sign up to the Paris Agreement with a goal of limiting global warming to 1.5 degrees centigrade. So whilst you've seen these targets set and agreements made, for possibly one of the first times in history, actual true global collaboration, this in itself presents monumental flows of capital potential across some of the solutions enabling us to reach these goals, and can actually provide, as we see this economic restructuring, a multi-decade megatrend, potentially the size we've never actually seen before within our investment lifetimes. And whilst you can see those agreements have been made, targets have been set, if we are actually going to make it anywhere near to reaching net zero by 2050, there is still a huge amount of spending that needs to increase. Forecasts project that spending needs to triple to between 1 and 2 trillion US dollars per year. If you use renewable energy as an example, clean energy needs to become 60% or more of total energy production from the 15% it is now. On the right-hand side, using Europe as an example, they are often considered really at the forefront of this shift to a cleaner economy. McKinsey projects that if they're going to make it to net zero by 2050, they need to spend 28 trillion euros by then. And what's interesting, you can see in this chart, that breakdown of capital, whilst clean energy is important, power, shown at the top or in black there, actually represents less than 10% of the total capital that is required. President Biden's been very vocal across the board with his ambitions for a cleaner economy, or net zero clean energy being the primary focus in many people's mind. He's gone as far as to outlay a $2.25 trillion infrastructure plan, covering a range of areas, clean energy being one, but electric vehicles being a huge part of that as well. So whilst clean energy is important, if we're going to reach these targets, you're simultaneously going to have to improve the building efficiency of every building in the world, transition your agriculture and completely modernize it, and improve regenerative practices. And also, as Nathan mentioned, to electric vehicles, you're going to need to change every internal combustion engine and electrify it if we're going to meet these targets. And that's going to require monumental spending across these areas. There's an interesting view of when you're looking at fund managers and when they're looking to attract capital, what have we seen over the last couple of years? And this chart actually breaks down the cumulative monthly flows of unlisted equity funds from across the globe. So not just here in Australia, but all across the globe. Those with a sustainability objective labeled as ESG and shown in orange at the top, they've seen considerable inflows over these last 2 years, whilst those without an ESG objective, on the whole, we've been seeing a steady increase in outflows. So whilst it appears that it's crucial for fund managers looking to attract capital to incorporate some form of ESG framework, that itself has knock-on effects. We've seen increased scrutiny from regulators, end investors, and fund managers when looking at companies to invest in. So as a CEO, if you're looking to raise capital, you really do need to be thinking about incorporating some climate emission avoidance within your company practices. And companies they're actually responsible for 3 different scopes of emissions. Starting with scope 1, you're looking at direct emissions from their owned and controlled substances. Scope 2 is their purchased energy, that's where clean energy comes in. And scope 3 is the more indirect emissions from upstream, so goods that they purchase, or downstream, whereas the products they're selling, how do those impact emissions themselves? This slide itself does quite a good job of just illustrating where some of the companies which are held within ERTH are enabling companies to reduce their emissions across these 3 scopes. So scope 1 on the left-hand side, you're looking at things like electric forklift trucks or electric delivery vehicles, or highly efficient climate control systems. Again, scope 2 in the middle, they're the renewable energy companies or clean energy. And it's scope 3 on the right-hand side, which is a really interesting area, and actually has been forecast to be the area which is responsible for the most climate emissions, so potentially where the most amount of spending needs to happen holistically. But things like waste avoidance, reducing corporate travel through Zoom. Companies can actually write off some of their carbon footprint by no longer flying to meetings across the board. Improved goods and services, so that's efficient timber, for instance, and their pollution and recycling down at the bottom. So these are a couple of company examples that are held within ERTH's portfolio, and just gives you an idea of how they're enabling, as companies set and aim to reach these targets of carbon neutral, just like Apple have across their supply chain. Companies will need to spend in these areas and show that they're making enhancements. This slide goes to illustrate something that Nathan actually touched on, is that transition or stranded asset risk, a relatively new risk, but as we transition to a greener economy, it really actually leaves risk with some companies, particularly say energy companies. And there's an example here of a lot of assets held on their balance sheet open to risk or potentially can be completely written off. So if we look at energy companies, 33% of oil reserves would need to remain unused, 50% of gas and 80% of coal reserves will need to remain in the ground from now until 2050 if we're going to make these targets. So that can have huge knock-on effects for the companies themselves, but banks, insurers and investors who have exposure to these companies. And it's for this reason we think ESG screens are still incredibly important, even when you're investing in decarbonisation strategies. Removing that fossil fuel exposure still ensures that it's an ESG product, but that also reduces some of that stranded asset or transition risk. And just coming towards the end here to summarise, the 5 key areas which are most likely to benefit from these flows of capital can be split into 5 sections. So clean energy is one, but you have things like green transportation, that includes electric vehicles, green energy, sustainable products, that's efficient building and food solutions. So say Beyond Meat would be an example there. You have enabling solutions, so alternative fuel cells or battery technology, and then water and waste reduction, so recycling, pollution reduction, water efficiency. And all of these 5 segments are held within ERTH's portfolio, so diversified across the board there. Just looking a bit more specifically at the index methodology, so in order to make it into ERTH's index, companies must derive the majority of their revenue from each of these companies, from something within these segments. They must be revenue generating and have a minimum market capitalization of $200 million US. It's a total of maximum of 100 companies within the portfolio, and the maximum stock cap is 4%. The index is rebalanced on a semi-annual basis, and we do incorporate those ESG screens. Just to round off, so this slide gives you a nice illustration of where some of these companies sit, a few holding examples and how they might impact consumers across the board. We do have a fully transparent portfolio across our ETFs such as ERTH. You can access this on our website and download the Excel spreadsheet to look through in your own time. And from there, we've got plenty of time for Q&A here. We actually had a couple sent through, and pretty interesting one that I'll actually probably hand over to you here, Nathan, as the expert. But looking at the transition to electric vehicles, when do you expect electric vehicles to actually make up 100% of total production, new car production?
Let me think about this. So Morgan Stanley, the number that we've been using is that we expect to see EV penetration reach 60% of the global fleet by 2050. All right. I think probably some people are probably thinking that number should be higher by 2050. Well, one of the things that we do remind people is that one of the big sort of bottlenecks within the transition to fully electric vehicles is the battery. The current battery technology is a significant CO2 provider. The materials that go into it, some of it is derived from really unsustainable mining operations like child labor for cobalt mining. There is no good battery recycling infrastructure. We need to get a lot of that nickel back if we want to use it again. And there's been sort of difficulties in finding reliable sources for a lot of these raw materials. So that kind of move towards electric vehicles, we definitely agree that that's happening, but it's probably going to take a little bit longer than probably some of the bulls out there are thinking. The other thing that you should be thinking about as well when you're thinking about electric vehicles is the knock-on effects to other industries. And this is going back to the point I made earlier about how when somebody wins, somebody else is losing. One of the areas you need to be worried about actually is the DIY market. So people who actually sell spare parts and allow people to fix cars, fix their own cars. It turns out that electric vehicles have got something like 1/100th the number of moving parts versus an internal combustion engine. So there's going to be a lot less need for maintenance of vehicles. So think about companies that are exposed to that segment. Another thing you should be thinking about, and again, this is something that a lot of people aren't really sort of factoring in their thinking about the model, about what will be the global fleet of cars look like, is that yes, while we all can agree that there will be a lot more electric cars, the absolute number of cars may actually be a lot smaller than we are today because of autonomous driving. And Morgan Stanley's view is that we'll reach L5 or fully autonomous vehicles starting by around 2040. When you start getting into that scenario, you can start thinking about, like, for example, a home right now where they may have 2 cars. Going forward, they may only need 1 car because that 1 car can drop off mom and dad at the office and then swing back home, grab the kids, and then take them to school. That there's no longer a need for 2 vehicles. So the way you should be thinking about the disruption from electric vehicles, the disruption from battery technologies, is identify where are the bottlenecks, and also at the same time, what are the knock-on risks of this transition to a new technology. I hope that answers your question, Alistair.
Absolutely, it does. Thank you very much, Nathan. We've had a question here. I can probably answer this one, but looking at some of the holdings overlap between ETHI and FAIR mentioned previously. So there are sustainability leaders funds and the overlap within those and a exposure such as ERTH. Now, looking through the portfolio holdings, we don't have something we can send out to you, but looking through the portfolio holdings, there is actually minimal overlap between the 2 exposures. There are some stocks which make it into both ETHI and ERTH, but the objectives of the fund are quite different. Whilst ETHI focuses on the large cap companies across the world, which are the climate leaders within their field and meet ESG screens, ERTH is really looking at the disruptors and solutions enabling decarbonisation. So I would really recommend downloading the full holdings of both funds and comparing those 2. It should be easy enough to see what's in both, but we can also look at potentially providing more colour on this through some of our send outs. Another question looking here at some comparing actually questions around greenwashing and the increase in greenwashing across, as we have seen a substantial increase in the number of ESG funds across the board and how it's being incorporated into portfolios. How do we at BetaShares, and that's actually a similar question to you, Nathan, as to how you at Morgan Stanley, and I can start with you, ensure that you aren't just greenwashing portfolios and have actual rigorous processes conforming to ESG, your guidelines?
Okay. I'd encourage you to go back to one of my earlier slides when you saw that our 4-pillar approach in terms of the way that we break down responsible investing. The first and foremost, the underlying principle that we have when we're doing our work and we're trying to assess whether or not a company is aligned with one of these 4 impact approaches is that you really need to do holdings level analysis. You really need to get into the weeds. You really need to lift the cover under inside the portfolio and look at a line by line basis. That each holding aligns with the impact approach that they state that they're doing. There are many examples in the market where you will find certain products that say, we don't invest in X, but then when you go into their portfolio, you'll find that they've got companies that are major investors in that X activity. And it is that sort of simple first step check that we really pride ourselves at Morgan Stanley in doing. And the reason why is because it's actually really hard to do that. In much of the rest of the world, you can actually get holdings level analysis. You can do it quite easily because that information is widely available. Unfortunately, here in Australia, it's a lot harder. A lot of fund managers only really disclose the top 10 or maybe the top 15 holdings, whereas a typical portfolio can hold anywhere between 60 to 100 stocks. So we need to basically systematically, one at a time, scroll through and dig through each one of these managers and make sure that, and the commitment that we make to our clients is that we make sure that what they say that they're doing, what they say that they're doing. So I guess no matter what approach you take in terms of trying to deal with greenwashing, I think it always has to start from that basis of integrity. That your approach as well is really trying to cut through the noise and really get to the heart of what that portfolio is doing.
Absolutely, and I think when it comes to BetaShares' approach to our ESG funds, it is really about being true to label across the board. We have transparent portfolios, and there are a couple of outstanding holdings that you might see in some other ESG indices, whether they're just excluding ones or giving scoring systems. So it really does sit on making sure that you look through the full portfolio holdings, but we pride ourselves on being true to label, both incorporating very, very stringent negative screens, positive screens, so allocating capital to those which are driving change, but also we have a responsible investment committee, which is probably a standout for BetaShares, because everyone's got a different view and there are a lot of grey areas that come up with responsible investing, and you can have controversies which pop up which wouldn't necessarily have been foreseen. A responsible investment committee enables you to ensure there's some level of human oversight, but remain passive in your investment nature and provide some really true to label exposures across the board. And I think the success of that has been shown in the capture of flows across the BetaShares products when it comes to responsible investing ETFs in Australia. As I mentioned before, we've taken in over 2/3 of all flows there, as investors have really flocked to that true to label exposure across the board. Another question here, we often get this about our funds, is what's the projected dividend yield for this fund? Now, I can't give you a projected yield on the fund, but what I can tell you is the 12-month trailing yield of the index, now this is not the fund, but this is the index of the underlying companies, has been 0.8% as of the fund launch. So when looking at things as an income investment, I would say companies like this, which tend to be the large disruptors in their field, wouldn't necessarily sit in that high income part of the portfolio. But yeah, that trailing yield is 0.8%. Question here around where hydrogen actually sits amongst those 5 segments. So hydrogen sits in those enabling systems, looking at alternative fuels and where they are. Like how does it impact transport and steel production? Nathan, I don't know if you have any insight into sort of the future of hydrogen technologies there at all, what you envisage those going forward. We've had one here. It seems to be a question that comes up reasonably quite a lot across the board.
At Morgan Stanley, our view is that hydrogen is definitely part of the mix. As I said earlier, there's going to be you need multiple solutions to deal with the range of issues that we have in terms of trying to get our collective carbon footprint down, and hydrogen is definitely the way. Just so to put that in the context, one of clearly the challenges with hydrogen is that if you think about it, hydrogen itself, it's not a source of energy. It's just a way of transporting energy from one place to another. So why I bring this up is that one of the green ways to produce hydrogen is through electrolysis. And what the Europeans have started to experiment with is basically to use abundant free renewable energy to crack hydrogen and oxygen separately out of a water atom. Then you end up with O on one side, you end up with H on the other side, and then you would then use that H, you transport it through a pipeline, you put it into a car that uses a fuel cell, and then away you go. The thing is, the amount of energy required to actually to break the atomic bonds of a water molecule and then deliver it all the way to a car means that you might actually you are better off just taking the energy that you got from the solar panel and put it straight into the car directly. So you have to remember that there are some practical limitations in terms of using hydrogen, and also like using hydrogen for airships. Anybody who knows a little bit about history knows that one's a little fraught with danger. That again, you kind of need to think about, well, hydrogen can be used for transportation, but it probably needs to be more like, say, trucking or maybe like ships. That makes a bit more sense, right? Hope that gives you a bit of color on how we're thinking about hydrogen.
Absolutely, that really does. And no, thank you for that. And it is, like I said, a question that comes up. I think the possibilities with hydrogen really do seem to capture a lot of imaginations across the board. Question here just on the index construction and rebalancing. So, as I mentioned, the index is rebalanced on a semi-annual basis, so twice a year. Question on, are the benefits to rebalancing more often, such as quarterly, given the fast-changing nature of the industry? Now, it's an interesting question and doesn't just apply to ERTH, but the rebalancing frequency of our different funds will actually vary according to their index. We're of the view that when you have a fast developing and disruptive industry, such as many of the companies within here, there are benefits to having a market cap weighting like we've seen, but actually letting them run for some aspects. So actually going more frequently than semi-annually, you can by selling your winners every quarter and buying back your losers, you can actually cut some of the momentum that you're building within those exposures. So keeping it to something like semi-annually, where there are benefits to rebalancing, but not doing it so often that you ruin your momentum can be crucial. Whereas something like a factor exposure will have smaller stock caps and rebalance more often. So it really is on a fund by fund and exposure by exposure basis across the board. Question as to whether ETHI would be more of a core holding than ERTH. Look, this is something that each investor really needs to think about themselves, but ETHI does provide a larger cap exposure to some of those more blue chip companies across the globe. You could think of ERTH as potentially a more thematic or impact exposure that can complement an exposure like ERTH and actually give yourself exposure to a mega trend as opposed to an ESG screened or ESG aligned broad portfolio of stocks. With that, I think we've probably come to the end of our time here. Thank you very much for joining us today. Thank you, Nathan, for all of your insight there. As I mentioned, a recording of the session will be sent out to investors or attendees, and we hope to see you next time. Thank you very much.